Hello and welcome to a very special episode of the podcast. Today we're delighted to be joined by Simon Barnard, manager of Smithson Equity Fund, which invests in small and mid-cap companies with superior operating numbers. Simon, thanks for your time today. How are you?
Good, thanks, James. Nice to see you.
Excellent. Now, following the transition from an investment trust to an open-ended fund, you're sticking with that strategy of investing in quality global small and mid-caps. But have you had to increase the liquidity profile of the portfolio since the conversion?
Actually, not at all. And in fact, before we decided to go through with the conversion, one of the main reasons we chose that is because we were already running the trust in a way that we wouldn't have to change anything, and we recognized that the liquidity was fine. But to put it into perspective, I mean, we list ourselves as small and mid-cap, but actually we're more in mid-cap. Our average market cap is around £5 billion of the underlying companies. And the liquidity in that is very strong. I mean, I think we've got about a 7-day liquidity of 97%. That means we could liquidate 97% of the fund within 7 days. So we've not had to change anything.
Right. And so you haven't seen too much selling since the conversion. Investors have chosen to stick with the strategy, have they?
Yeah, well, when we went through the conversion, we bought back around 58% of the fund at NAV. But bear in mind that included the activist hedge fund that got involved with the Smithson Investment Trust. And it also included quite a few other institutions that could only hold investment trusts, and they couldn't come with us into the OEIC. So our estimation was only about 20 or 30% of that was underlying retail shareholders.
Interesting, I suppose. The benchmark is always going to be returns. So I just wonder what sort of steps you've taken. The past few years have been a tricky place to be for the trust and now the fund. Just wonder what sort of steps you've taken to address any returns dips that you might feel you've had.
Yeah, well, I mean, we're always looking for improvement, and especially in times like this, when we've had underperformance for a year or two, we step up those efforts in terms of the post-mortem. And I think there are a couple of things that we identified that we could have done better. One of those is broadening our investable universe. So this is the list of companies that we have found in the world, because we have a global mandate, that are the highest quality mid-cap companies that we can find. Currently, the list is about 95, and that has expanded. And we've made a concerted effort to broaden that list into different areas of the market that we've not looked at before. And the second point that we realized is that we had been holding on to our winners for too long, and once they'd got to quite stretched valuations. So addressing those two issues has actually already started to help. So, for example, by broadening into different parts of the technology sector, we found a company called Vertiv listed in the US, which we bought last year, and that's already up 4 times in value since we've owned it. And then on the second point, last year we sold 2 companies, Equifax and Verisk, both of which had reached relatively high valuations. In fact, some of the highest we'd seen them trading on in their history. So we sold both of those, and actually since then they're both down around 40% within a year. So I think those steps alone have already started to help.
It's always one of the toughest things to work out, is any investor, retail or professional, is when do you sell a stock? And the idea that you run your winners, it sounds so simple at its heart, but there's so much complexity in it, and it's such a difficult decision brilliant, we're up 40, 50, 60%. Should we sell it now?
It is. And I think you just have to be disciplined on valuation. And it's worth remembering all of these points I'm mentioning are simply tweaks. We believe very strongly that our underlying strategy of buying good companies, not overpaying for them, and then holding them for the long term is the correct one. And it has worked over many years, if not decades, in other people's strategies. So these are only tweaks we're talking about. But I think being more disciplined on valuation can't hurt you over time.
Yeah, great. James, I'm just going to leapfrog a question here because it kind of segues nicely. You mentioned Vertiv. I know the company relatively well. It's very much in the kind of AI infrastructure space. Just looking across the top 10 holdings, there's not an obvious lever into the AI investment theme. I just wonder what your feelings are about AI and where the fund positions itself in terms of that theme.
Well, this could be a long answer, but I mean, on AI generally, look, clearly, there is no question that this is a game-changing technology that is going to change a lot of things and the way we do things in the world. And we've even observed that ourselves in the way we've deployed it within our team. You know, tasks that used to take days or weeks are now taking hours. And it's really made a big difference in the way we operate and the speed at which we operate. So I think that that is a clear point to make first. However, I think investors have become particularly enamored with certain areas of the market related to AI. And I think we're getting to the point now where it is becoming difficult to justify the valuations in some of these areas, however much growth we expect from this game-changing technology. And it's also starting to become difficult to justify the amount of capex that's being spent by some companies in this area. So I think these are big question marks rising up over the assets related to AI, however strongly you believe in the AI technology itself. So for us, because of that very clear structural growth in the technology, we do believe it's important to have some exposure. And I've mentioned Vertiv, which is a US-based producer of custom liquid cooling solutions for data centers. So clearly right in the mix of AI demand. But we also have some other companies like Belimo, which sells actuators that, so these are automated devices which open and close valves for either water or air movement, also actually feeding into liquid cooling solutions for data centers. In fact, they have the #1 position in actuators for liquid cooling. We also have less direct exposure through companies like Diploma, for example, that through some of their divisions are supplying cabling and other infrastructure for data centers. And we have other semiconductor-related companies like Infocon, which sells vacuum sensors into semiconductor manufacturing. All of these companies have done extremely well during this process. But while acknowledging we need exposure to this theme, I think we also, going back to my earlier comment, need to be cognizant of the valuation. So there have been opportunities to get hold of these companies at reasonable valuations. So we bought Vertiv last year on 20 times earnings. I mean, it was incredible. Helped, of course, by the sell-off in the Liberation Day announcements. And we've recently had a chance to buy Belimo, because it sold off during the Iran conflict concerns. So we've had opportunities. But now that, for example, Vertiv has gone up 4 times in a year, its earnings of expectations roughly doubled. So now it's on 40 plus times earnings. You know, this is a different equation. And put it in perspective, we bought a 3% position initially. You said there's nothing in our top 10. Well, if we'd left that to run, it would be over a 10% position now. We'd have to adjust that for UCITS rules, but it's a 2% position. So you can see there, again, our discipline on valuation taking effect. And so we are, you know, I think a lot of the market is coming into a difficult point now. How do you justify these valuations and how do you maintain your exposure when valuations are stretched?
Indeed,
Right.
indeed.
Yeah, and any other sort of other parts of the market, you know, with your sort of preferred hunting grounds of quality and SMID, where you're seeing particularly good value?
Yeah, I mean, in a word, lots. So, I mean, the counterpoint to what we've just been talking about is, you know, there are a lot of older world, let's say, stocks, which are very high quality, still growing high single digits, low double digits, but are at extremely attractive valuations. And actually, even when we look at the portfolio as a whole, the Smithson portfolio is now the cheapest it has been for the last 10 years or more. And for the first time since inception, when we look on free cash flow yields, the portfolio is now cheaper than the market. And that's bearing in mind that we own higher quality, that means higher returns, higher margin companies, which are growing faster than the broader market. And because they're in the quality bucket, they're now cheaper than the overall market. I mean, we've not seen this before, and it's actually making us quite excited. So we've just seen in the last few days actually there's been quite a sharp sell-off in AI-related assets, and all of these companies suddenly jumping in price. So you can see that there's quite a clear counterbalance here. But it is very much the case that we are surrounded by opportunities in these types of stocks.
Excellent. Now, I was also going to ask, just looking at the fact sheet, there's that large allocation to the US. Is there anything structural at play? Is it superior margin businesses or management teams? What's the reasoning for that?
Not in that way. We don't sit here thinking we should have what we currently do, which is about 50% in the US and 40% in Europe. Rather, it's a very bottom-up approach. So we're constantly scouring the world for the best quality companies that we can find in our mid-cap range. We follow them as if we own them, and then on any given day when the valuations are attractive, then we acquire a position. And so that allocation to the US has broadly been bottom-up through that process. But that clearly means that around half the opportunities that we currently see right now is coming from the US. And the reason for that probably is because when you think about small and mid-cap companies, actually their domestic markets are more important to them than for large cap companies. Clearly because they haven't grown to the point where the international markets are becoming larger than their domestic market. And so it's worth remembering that the US is still the world's largest, most liquid, most dynamic, most business-friendly market in the world. And so you're just going to find the most attractive companies there in general at this point, which is why half our portfolio happens to be there.
It's interesting, Simon, that just looking at the UK market over the last couple of years, it's rallied up from 7,000 odd to now over 10,000. Seems like it's had a very strong run, and of course it has. But I mean, lots of commentary and conversation we've had in recent times. Managers seem to be looking at the UK still as very, very discounted, certainly against the US and even against other parts of the world. Is that your experience as well? Are you finding quality companies at below quality prices?
I'd say yes and no. So funnily enough, over the last few years, we've had a significant overweight to the UK in the portfolio. So 15 to 20% of the portfolio has been in the UK the last few years, when we thought it was extremely good value for the type of quality companies we were looking at. However, actually, over the last year or so, that has reduced quite meaningfully as those companies perform so well. And we are looking at valuations now in the specific areas where we're focused. So, for example, HLMA is a company that has done extremely well for us. We've owned that for 7 years and have only very recently sold out of it as it's gone beyond, I think it was 30, 35 times earnings, which for us we felt was becoming stretched. And Diploma 2, we had a very large position, but again, is becoming increasingly highly rated. So we've been reducing that. So funnily enough, that weighting to the UK for us has been reducing over the last 12 months, but only because it's done so well. And we still do own companies in the UK, which we still believe are good value, but just for us, it's actually less so.
Right. Yeah, I just had a stock specific question as well. Just turning to luxury, Moncler. Perhaps what makes that business special? You know, why have you picked that out of all the kind of bling names you might have opted for?
Well, the first thing to say is luxury is an attractive industry. Okay, and you know, you only need to realize that human greed and vanity are eternal, and you need, therefore, this luxury industry will be attractive probably for a very, very long time. And you can see that in the numbers. You know, over the last 25, 30 years, the luxury industry sales have been growing at about 6 to 7% CAGR. So it's up, you know, 5 times in the last 25 years. And within that, Moncler has done even better. So Moncler is an extremely well-run, smaller luxury company. And so, you know, over the last 10 to 15 years, their growth has been more like 16% a year, with a higher gross margin than the rest of luxury. So luxury on average have gross margins around 70%, and that speaks very much to the pricing power that they have in luxury goods. Whereas Moncler, their gross margin is more like 80%, so even better. And the growth they've experienced is clearly taking market share, and that's because as a smaller company, they've been opening more of their own brand stores, and they've also been adding more lines. So Moncler obviously has this heritage of outerwear. So, you know, in the 80s, it was shiny puffer jackets. Now it's a bit different, but they have been broadening that offering into knitwear, into footwear, into accessories, something that these larger groups have done, many years ago. Moncler is just going through this process now, which is why they've experienced such strong growth. But on top of that, they bought another brand called Stone Island back in 2020. And this has added a whole new leg of growth. So Moncler actually, in the early 2000s, was almost going bust before it went through a management buyout by its current CEO, chairman, Remy Ruffini, who did an amazing job rebranding the company, redesigning all the product and elevating the offering in terms of price and value, and getting Moncler to where it is today. So now they have acquired another brand, Stone Island, which is in a similar spot to where Moncler was in around 2000, and they can just apply the same playbook to it again, and clearly avoiding some of the mistakes they made to accelerate that process. So we've got this whole new leg of growth coming from Stone Island for the next 10 or 20 years. Now, what makes it exciting right now is, of course, due to the Iran conflict, a lot of luxury stocks, including Moncler, has sold off because people are worried about luxury sales in the short term. But actually, for Moncler, only about 2% of their sales are in the Middle East anyway, so it doesn't really affect them all that much. Yet the stock has sold off with the rest. So it's now trading on over a 6% free cash flow yield, or about 18 times forward earnings, which again is the cheapest I think I've ever seen it. So you've got this incredibly attractive valuation entry point for a business that achieves double-digit growth over the long term. So I think it's very attractive.
Well, thank you, Simon. I think that's a perfect place to wrap things up. That's a fascinating insight into the Smithson Equity Fund now, was the Smithson Investment Trust and no longer. Thank you very much for your time. And listeners, thank you very much for tuning in to this podcast special with Simon Barnard of the Smithson Equity Fund. Till next time, cheerio.
Thank you.